It's Victoria from TRADEPRO Academy, and today we're going to be talking about options pricing, right? Options, strike selection, and expiration. So we're talking about directional options day trading. We are going to be very, very selective on the strikes, right? Even with swing trading. If you're going from a directional perspective, you want to get a certain degree of strikes that are going to be the correct strikes. There are a lot of strikes that are the incorrect strikes. Throughout 2022 and even into 2023, it's going to be harder to trade directionally in the options world. A lot of the volume that had come out throughout 2020 and 2021 is dissipating from the market. There is a decrease in the money supply throughout the markets as well, and options don't necessarily move as they once did in 2020 and 2021. So that means that we have to be very, very cautious of what kind of strikes we're selecting and avoiding the strikes that we shouldn't. So we're going to explain exactly what it takes to look for a good strike, whether it's swing trading or day trading, and which strikes to avoid throughout this video. But for that to happen, we're going to have to jump onto a computer screen, so I'll see you guys there. Right, now we're on the screen here, and what you can see is the options chain. You can see the options chain for the SPY right now. We can look at other options chains as well for different criteria and different examples for different options. But as a day trader, what we're going to be doing right now is breaking this down for day traders and swing traders, how to actually look at the correct strikes to choose from. Now, naturally, there are, like I said, more so incorrect strikes, and we'll talk a little more about that. But there are many correct strikes. It's not one correct strike. There are just many incorrect strikes to choose from, and I'm going to show you exactly why and what's going on there. Let's start with the day traders first. As a day trader, the main thing that you need to understand is that if you're in and out of position throughout the day, right? Like the point of day trading is to open a position and close it that same day. You're going to be looking for an expiration date that is going to be very short. Now, why I say this is because options positions, right? Options contracts, you do pay for time. Now, the farther out you go, the more money you're going to be spending on time, which is not necessarily what you need for a day trade if you're in the trade for a few hours. Now, the thing with this is they do become more volatile when you consider this, right? If you consider paying for time just for a day trade, know that your position is not going to move that much as a percent of the premium. For example, for a very similar move, maybe it's a 2-point move on the SPY, a position that expires in a week, right, maybe has a 30-40% gain on the premium. One that expires in 3, 4, 5 weeks out is going to have a small portion of that gain for the equivalent move. So keep that in mind. Now, when you're looking at day trading options, typically you go the week of, right? You look at the week of expirations, and you also, for equity indices like the SPY and the triple Qs, you have multiple different expirations throughout the week. If we drop this down here on the SPY for different expirations, you can go weeklies and quarterlies, and you'll see all the expirations, right? Today's the 14th of September. You can see we have the 14th, 0 days. We have 2 days out, which is the 16th. We have 19th. You have a plethora to choose from. So that's great to trade indices, because even as you get into the latter portion of the week, when options timeliness really decays, and you're going to have to be very careful the last 2 days of the week, you're going to see a lot more volatility, right? Even if we look at a 0 day, for example, we look at today's, you're going to see that the options pricing into the end of the day is very drastic from those that are in the money, right, at the money, and those that are out the money, right? You look at 2 days out, and again, very large differences. So you're going to have to consider that when you're day trading options. When you come into expirations, right, and you have to decide, okay, what kind of expirations am I going to choose? For ETFs, right, like the SPY and the triple Qs, even IWM, look for something that's like 2, 3, 4, 5 days out on a consistent basis, right? Those expirations are going to be fairly good, right? If you're looking at a just general name, maybe like Tesla, for example, you look at Tesla, you can look at things, expirations that are that week, right? The current week. So something that is even 2 days out, right? When you get into Friday, you might want to consider next Friday's expiration, because those ones only do expire on a week-to-week basis. So when we consider this, right, when we consider that there are shorter expirations, you're going to have to understand that the volatility of the movement is going to spike in these options. So that means that you have to consider multiple different things to not only avoid the incorrect option, but make sure that you have a chance of selecting the correct option. And there are three different aspects that I do want to talk about when we consider this, right? We're going to be talking about the Greeks. We're going to be talking about the moneyness of the options, and we're going to be talking about volume and spreads when it comes to day trading options and selecting that overall correct strike. So when we talk about Greeks, there are three main Greeks that I do want to focus on, right? Two are a little more important than the last. We have theta. Now, theta is the time decay of the options contract. The theta generally starts burning the premium of the options contract within the last 30 days of expiration. This is very, very important for day traders because, right, the theta will burn aggressively when you're very far away from closing or expiring the option in the money. So especially in the last few weeks of the life of this options contract, the theta decay will act very, very rapidly, and you're going to need a move that can counteract that theta decay, meaning that you're going to have a strong move in your direction to counterbalance whatever theta decay. So that comes into consideration. What kind of option will I select? And that has to do with some of the moneyness, especially options contract that expire on the 0 day, on 2 days out, on 3 days out. Their theta decay is going to be very drastic depending on what kind of option that you select. So we can talk about delta, and that kind of brings out some of the moneyness. Delta is going to be the rate of change of the options pricing, right, or premium based on the move of the underlying. Now, the delta here you can see on the options chain is present, right? We've thrown on the delta. This is for Tesla right here. And the delta for this options position, right, is going to be pretty important because we do want to select a delta that is maybe slightly out the money, maybe at the money, maybe in the money. But the point is, if we're looking at delta as like the sole reason, the sole Greek to choose from, we are going to be considering a delta that is at least around 25, right? A 25 delta, which is pretty low, because what that suggests and what that tells us is that if you're looking at the underlying, right, a $1 move in the underlying is going to be an equivalent of a 26-cent move in the options position, or a $26, because remember, there's 100 contracts in each of these contracts, or 100 shares in each of these contracts. So it's going to be a $26 move. So about 26% of the underlying is contributed to this delta. Now, delta does change. The more you get towards the in the money options, the higher the delta increases. So at one point, if you're right and you choose this 310 delta, maybe price goes from about 304 here on Tesla all the way to 309, and all of a sudden this delta is now in and around 43, right? It's in and around 50, right? So this delta reading does change, and we don't want to select the delta that's too far out, because number one, when you get a move in your direction, that delta is not going to gain much value on the underlying until you get very close to that actual strike, right? That's step number one. Another thing to consider with super far out low deltas is, yes, they might be cheaper, but if it doesn't move in that direction very quickly, those are going to go to zero very, very quickly, because a lot of these positions are actually sold to collect the premium, especially on shorter expirations. Now, delta is one of the main reasons we take a look at these chains, right? We want to understand what the delta reading is so we can have a ballpark figure of which strikes we do want to select. Now, another Greek is gamma. Now, gamma is the rate of change of delta. So when we have gamma right around the at the money position, that is going to be when gamma is actually at its highest. So when we are at the money, the gamma changes the underlyings, the underlying's positions delta very quickly from in the money to out the money, right split in the middle. So this gamma reading is going to affect how quickly the option does gain value based on its delta. So the farther you go out in the money and out the money, the smaller the gamma reading is, meaning that when you're selecting super out the money options here with very low delta, right, even moves that are in your way are going to take a very long time to actually churn a decent profit versus those that are maybe closer to the high gamma strike, right? At the money positioning. So when we also talk about strikes and selecting the right strike, it's not just the Greeks. We also have to consider the moneyness of the option, especially as a day trader. Some people do like to look at in the money options because they do reflect the underlying the best, and that is because they have the closest delta to one. When you have a one delta, right, that reflects a dollar 1-to-1 ratio change in the underlying. So if the underlying moves a dollar up, right, your position is going to gain a dollar per contract. Right. This is going to be the closest that you're going to get to the underlying, right? When you're super deep in the money, but that also comes at a very high price. So pricing of these options is to consider as well. Now, the moneyness, you can look at typically as a day trader. I would suggest something that is close to at the money or just slightly out the money, where you have at least a 25 to at least a 30 delta, because these positions, you can see that they're not very far off of the at the money, just because they have a very, very close to zero expiration. The delta difference is going to be very, very wide, right? So you start with a 50 delta and all of a sudden just 3 strikes down or 4 strikes down, you're all the way down at a 20 delta. For example, if you compare something that's very far out, 23 days out, right, at the money, you're about a 50% delta. You go a few strikes out, you're about 40% delta compared to 2 days out, where you go from about 50-ish down to 18, out down to 20, right? So keep that in mind. When you're talking about the moneyness, I would suggest looking at something that is at the money, right, down all the way to out the money, closer to a 30 delta. Why is this? Because yes, the cheap options are super out the money, but remember what we talked about when it comes to delta, gamma, right, and all those things, and theta, right? The Greeks are affecting these out the money positions very drastically because these are usually sold premium, so people can just collect that premium from people who buy super cheap options because they're super cheap and they can buy a lot of them, expecting a very drastic move in that direction. Now, naturally, sometimes you do hit a home run where you buy an $18 options contract and all of a sudden Tesla rips like 10% in a day, and this $18 turns into $2 and you've made a giga amount of percentage gains. That does happen on a rare occasion, but if you want to do this the correct way, you're going to be looking at things that are slightly out the money to at the money on a day trade perspective, right? For those following reasons, right? You have Greeks that affect. Now, another portion that seeps into the option selection, right? Which ones not to select versus which ones to select. We've already defined that super out the money are not the ones to select, right? You start going past below 25% delta, you're really gambling with these positions, right? There's a pretty low chance that these become positive and that they actually churn a profit because they're being sold aggressively. And even though they're super cheap, the Greeks adversely affect the position unless you get a very, very powerful move. And that is something harder to come by, right? And eventually your option does end up being worthless. If there's no movement, sideways movement, and you're out here with a 325 call and the price of Tesla is at 304, right? You are very far away, right? You're about $21 away from this position, right? When you're that far away, you need a very strong move because this thing expires in 2 days with this low delta. Even if you go to like 308 by the end of the day, this position probably hasn't gained too much value realistically, right? If we look at this, like even like a 320, Tesla has gone up today, right? The 320, if you're picking it up, yeah, it went from $17 all the way up into about like $75, right? Which is a very, very good gain. But you take a look at like a 330, for example, the 330 goes from $7 to about 16 because Tesla did have a very strong run. Just these things don't happen very often, right? If you pick a slow moving market, for example, SPY, right? SPY did have some decent pops on the day, it had some decent drops. But if you're looking at some of these delta readings, right? If you look at like maybe some puts on something that's very, very close by, right? You go super far out the money, you get some of these puts that are like 5% delta. These positions on the day, right? They didn't do that hot, right? Even if SPY dropped a decent bit, they didn't do that great. So just keep that in mind when you're selecting these very far out the money positions. When they hit amazing, but the likelihood of them hitting isn't an everyday spectacle, right? Or you have to be extremely, extremely precise with your levels. So another thing in terms of selecting the right strike right, after eliminating a lot of the wrong strikes, is going to be the open interest, the volume, and the spreads, right? You also want to take into consideration how much money each of these options are, because that does affect your position sizing. When we're talking about volume and open interest, right, the volume of the option is how many contracts change hands, right? Multiple times. I can trade a contract maybe 50 times, and that is going to be attributed to the volume. Open interest is how many of these contracts are actually open. When I trade this 50 times, it doesn't mean this increases by 50. If there's this many contracts that are in circulation, this is what's going to stay. Me trading this is only going to affect the volume. So when there is heavy volume, that means there's heavy liquidity in the options contract that you're looking at. Typically is going to have a tighter spread, right? And a higher open interest also enables that liquidity. So when you select your options contract, right, let's say you are looking at anywhere between 305 and the 310s because of the delta reading, right? You're going to be looking at these and thinking, okay, well, this one has a lot of volume, right? It's pretty close to at the money. Maybe I don't want to pay this much money for this. The open interest is pretty high. This one also, somewhere here, right, the 310 is going to have a lot of volume traded, good open interest, and a very tight spread, for example. So that's the lowest I'll go. Round numbers typically have higher volume and higher open interest and tighter spreads, right, versus these ones 0.33 because Tesla recently split. But realistically, any of these would work. This volume is very high. You don't want to be trading super illiquid things. Like if you take a look at like Roku, for example, and you compare the liquidity to Tesla, it's going to be very far off, right? Something that trades with a volume of 280 contracts today, right? 1,000 contracts isn't comparable to something that traded at 70 or 78,000 contracts, right? So just keep that in mind. That affects the spreads and the liquidity and the ability to actually get in and out of these trades. So just keep that in mind as you're selecting these for day trade. So that pretty much wraps up how we like to select these options for day trading. And swing trading is a very similar concept if we run through that as well. Right, swing trading, there's the same components. You're looking at Greeks, you're looking at moneyness, you're looking at the volume and the spreads, but you could also consider, right, selling premium against positions. And we'll talk about that, and it does involve some risk. As a swing trader, you do need to understand that you're holding the position for multiple days out, right? I would consider overshooting the expiration, because as a day trader, you have a short expiration. As a swing trader, if you're holding a position for multiple days out, remember the theta decay, right? 30 days out of a position into its expiration, theta decay is going to actively go, right? Each day you're going to be losing X amount of dollars just because of theta. So regardless if the position moves in your direction, right, it's going to be undercut a little by theta. So I suggest overshooting the expected holding period. Maybe you want to hold it for a few days. Instead of getting something that's 9 days out, even consider getting something that's a few weeks out, even if you hold it for overnight or a few days out, right? It's better to overshoot it a bit just in case, because these theta burns, they can happen. And if you get a day of just no movement, then it's going to be very difficult for you to recover the premium that the theta burn. So if you don't want to scramble and watch the Greeks eat away at your premium, which could happen very easily in day trading, it's also hard to anticipate how long it will take for an underlying to move X amount of dollars. So I think it's better to add a few weeks to the original holding period. And again, right, you might need to add even more time because of that theta decay and that theta burn, right? Meaning that you have to get a move in the underlying that will beat out that theta if you are directional. So if we talk about theta, we've talked about it a lot. You want to ideally add a few weeks onto your holding period, right? So if I'm thinking that I'm going to hold this for a week at a time, right? 5 days, maybe when I look at the options contracts, I want to look at something that's 4 weeks out, for example. So that's where I look at the expiration. When it comes down to delta, you can be a little more flexible with the delta on the swings, right? You can look for delta on the swings that is even like 20 delta, something that's even further out, because you have to keep in mind that these are going to be expensive. They're going to be more expensive. So let's say with SPY, I'm looking at something that is October 21st for 37 days out, and I'm looking for some downside, right? If I follow the rule and I'm looking at like around a 30 delta or so, right? 30 delta, I'm going to look at this is going to be a $6 contract, right? You can look at the volume and whatnot, but if I look at a 20 delta, yeah, it seems very far away, but I also have 37 days for this to act, and it's $200 cheaper. So somewhere between 20 and even 25 delta, it seems very appropriate for a swing position, right? When you're very far out, when you have weeks out. In terms of moneyness, very similar to day trading, right? I prefer swing trading with fairly out the money positions because those ones are going to gain value fairly quickly, right? If you get a strong move in your direction, you're going to see those contracts gain good value and they're going to be a decent bit cheaper than what you're expecting to pay for something that's closer to at the money, right? If you're at the money, you're paying $1,200 for a position that's 37 days out. If you go out the money into even a 30 delta, you cut that price in half. Now, it's not the thing that we're looking for in terms of pricing, right? It's not like we're looking at pricing and we're thinking, okay, well, what is the cheapest possible option, right? That's the incorrect way to look at it. But when you match the delta with the expiration, you're going to find something that makes sense, right? In terms of the moneyness. Now, the same goes for volume and spreads as it did for day trading with swings. You want to look for volume that's thicker. You don't want to be swinging something that has incredibly low volume compared to its counterparts, right? 375, these rounder numbers are going to have elevated levels of volume versus something like 379, right? These might get some love as well. The spreads on SPY are very, very tight. They may get some love, but at the same time, you do want to consider where a lot of the volume in the open interest sticks. Now, the final thing that I do want to talk about in terms of swing trading is the consideration of selling premium against the position. Now, I want to show you guys something from our Discord here very quickly. When we talked about a position on Goldman Sachs, right? On Goldman Sachs, we had a position over here. And I was looking at financials a little weak. I'm looking at these November expirations for Goldman Sachs because it comes into a distribution block high, right, based on the volume profile. I'm looking at these 300 puts that are a few weeks out, right? November, it's mid-September right now. And this is the midpoint price. Now, what I added to this, I'm going to sell weekly and bi-weekly calls against the position to pay for it and collect the premium, selling the 355 calls. Now, there are some risks because you're doubling down, right? You're doubling down on the directionality of the position because what you're doing is if you sell calls and you buy puts, you're expecting price to go down necessarily, right? Even if it doesn't go down but stays stagnant into the expiration of the calls that you sold, you're still going to collect that premium, so you're not going to lose as much money. However, if the position goes against you, there is the risk of losing double that, right? So what you can do that's even a little different on the directionality side is sell puts, right? Creating a debit spread for this position. If I sell calls, for example, I really need this thing to go down, right? If I'm buying puts and selling calls, I really need this thing to go down. But what I've done is I've paid for the position with the calls that have been sold, and with this downward move that had happened, both of them gain value in my account very drastically. Now, another thing that you could do when you're swinging is considering selling puts with puts, right? If you're long puts, you can sell puts to create some of that premium so you can pay for some of the position, right? Or if you're long calls, you can sell some calls to pay for that position. Now, what it does, it creates a debit spread that actually does sandwich your profit potential. So if I open up this strategy builder here, let's say I want to get long the SPY for whatever reason, right? It's pretty interesting because I can now choose something that is closer and higher in delta on the position. Because let's say I buy this 401 call, right? It's pretty expensive. Let's say $100. But what I'm going to do is I'm going to sell this 410 put. Now, all of a sudden, instead of paying $800, right, I cut the difference and I'm paying under $300 or under $400 net for this position. But what I've done is I've capped my max gain right in between this $9 move. But which is fine because if it starts moving in your direction, you can easily just sell the short leg of this position, right? Take whatever is there on the premium side and then be done with it. Or just cap your gains at that, right? Remember, when selecting options, whether it's day trading or swing trading, you can select the option based on what your target is as well. So just keep that in mind. If you want to limit the actual cost of an option, you can implement something like this that involves selling premium. So I hope I broke down what not to do and what to do correctly when selecting options strikes, right? Because there are a lot of incorrect strikes to select, but there's an abundance of correct strikes to select as well. There's not only one correct strike. So with that being said, I want to jump into an outro. I hope you guys enjoyed this video and I'll see you on the other side. I hope you guys learned
which strikes mainly to avoid, and which strikes do look good when you're selecting options, whether it's day trading or swing trading throughout this video. This was the premise of the video, and there was a decent bit of information, so don't be afraid to rewatch it. But I'll see you guys in our next video. But what I want you guys to do before that is hit that like button and hit that subscribe button. Let's talk more about options. Check out our other videos, and we'll see you there.